What was once dismissed as conspiracy is now on the table. The Federal Reserve is openly considering a gold revaluation, a move that could rewrite the value of America's reserves overnight, create trillions in paper profit for the Treasury, and send shockwaves through the global monetary system, the dollar, and your savings. So why now? Because the United States is facing the most dangerous debt crisis in our history. Foreign demand for U.S. debt is drying up, de-dollarization is accelerating, and history is crystal clear. When governments run out of options, they turn to gold. Just last week, the Fed released an official research note. It outlined how debt-strapped governments have boosted their balance sheets simply by revaluing their gold. No selling, no mining, just a new price. This isn't a what if, it's a question of when. Right now, U.S. debt is more than 120% of GDP. In plain English, even if we poured every dollar of our economy into paying debt, we'd still fall short. This ratio has only ever topped 100% twice in history: the 1940s, World War II, and today. But there's a key difference. In the 1940s, the spending was temporary, followed by a post-war boom. Today, the spending is structural, and there is no plan for a rapid payoff. The Congressional Budget Office projects debt could hit 150% of GDP in the next decade, but many believe we'll get there much sooner. In 1971, when Nixon severed the dollar from gold, U.S. debt was $390 billion. Today, it's $37 trillion. To grasp the scale, stack $1 billion in 100 bills. It's half a mile high. Stack $1 trillion? It soars over 670 miles. Now multiply that by 37. That's the mountain of debt we're standing on. So what does the Fed do next? Enter the gold revaluation playbook. We've seen this before. In 1933, during an economic crisis, the U.S. government confiscated private gold. People turned it in, received dollars, and thought they were getting a fair deal. But once Washington held the gold, they revalued it higher. The dollar was instantly devalued. Paper holders lost wealth, gold holders gained it. Today, the setup looks different. Why? Because the U.S. gold reserves are still officially valued at $422 an ounce. That's the 1973 price tag. On paper, that makes our reserves worth just $11 billion. But at current market levels, closer to $3,400 an ounce, those reserves would be worth nearly $750 billion, and that's just at today's price. A revaluation could push it far higher. $10, $20, even $50,000 an ounce isn't out of the question in desperate times. And here's the kicker. No gold has to change hands. The Treasury simply revalues it, updates the certificates, and boom, instant profit without new taxes or borrowing. And anyone already holding gold, they benefit from that new higher floor. This is why institutional buyers are demanding physical delivery, not paper contracts. Why nations are reducing their exposure to dollars and turning to tangible assets like gold. Ever since the U.S. froze Russia's foreign exchange reserves in 2022, the world has learned the dollar can be weaponized, and trust in the system has eroded. That's why gold just overtook the euro as the second largest reserve asset globally. Here's the bottom line. If the Fed moves forward, those holding dollars will watch their wealth erode. Those holding gold will see its value surge. History shows this pattern over and over. Paper burns, gold endures. So ask yourself, do you trust government promises on paper, or do you trust a hard asset that has survived every currency collapse in history? The clock is ticking. Protect yourself with physical gold and silver, outside the system, outside the dollar. Because whatever comes next, it won't be pretty for paper. This isn't fear, this is preparation. History is repeating, and those who act now will endure.